Yo, what up, though? What up, though? It's your boy Train the Trader, and we're back with part two. So, picking up from the 200 EMA SMA tip that I gave in part one, we're going to pick up right where we left off. This is part two. This is the second piece of that tip. Let's get to the video. Yes, sir. Let's get it. Hope everybody's doing well. Please, first and foremost, like and subscribe. Hit that thumbs up. Hit the bell. Help me spread the love. Help me spread this education. And we're going to hop right in. This is part two, picking up from part one, where we left off talking about the 200 EMA SMA and how important that was. Well, I'm going to add something to it. Okay. And I can't take credit for these things. I do have to give a shout out to somebody that I learned a lot of trading from, Mr. Oliver Velez. Fantastic techniques. He makes this game really simple and has helped me a lot on my journey. So these are his teachings, and I am now bringing that to you. All right. So let's get into it. So we have our 200 plotted, same thing. And I've got a chart of Meta pulled up. So let's start with Meta. We're going back all the way to January 2020. And we're just going to track this price with this 200. Okay. So we are in a, what we learned, deep value zone right here. We got a run up, a bounce off of the 200. So it's holding that structure. Another run up, continuation. Oh, we get a pullback, consolidation right around the 200, and then we lose it. Boom. And not only we lose it, I have these here for gaps that I see in the market. So we gap down, lost the 200, stayed under the 200 for, let's see, that's February all the way to November. So the whole year was a down year. But oh my goodness, look what happens. Like I said, these deep value zones, the market can only go three ways: up, down, or sideways. We bottom out here. If you were smart enough to buy shares of Meta at $88, $90, I can only imagine how you feel right now, because look what happens when we reclaim this 200. Take off time. Take off time. And you see we have not gotten below that 200 since that time period. That's how important this 200 is. Okay? Now I'm going to add something to this. This is the second part of this tip, of this tool that you guys can use. I'm going to plot a 20 SMA, simple moving average. And that's this orange line. So this orange line, seeing that it's a 20 SMA instead of a 200, it's going to track the last 20 candles instead of the last 200. Y'all follow me? Hope that makes sense. Fairly simple. But what that also means is it's going to stay closer to the current price because it's tracking less candles from the past. And when you use these two things in tandem together, it gives you great insights for support, resistance, entries, and exits that you can really take advantage of. So you don't need a whole bunch of indicators on the chart. And that's one thing that I've learned. The more stuff you got on the chart, the more complicated it makes. It makes it harder for you to make decisions, especially when you're day trading and decisions need to be made quickly. So you need to keep things simple. Long term, this is even better. So if we're talking long term, buying equity, buying shares of a company that we're just going to hold, we can still use this. The value zone that we just mentioned back there in March 2020. Look what happens when it broke this 20 SMA. So you get an earlier entry than you would if you were to have waited. And that, ladies and gentlemen, right there alone is a difference of 143-ish to 183-ish, so $40 difference. That's a lot of money to be made in the market. So, because the 20 reacts faster and it stays closer to the current price because it's not tracking back as far, you're going to get those early indicators of when bulls and bears step into the market. Oliver Velez likes to use these with the example of them being a mother or father, being the 200. So this is mom and dad. This is the kids, the 20. So just like when we were younger and we used to go outside and play, when the lights came on, if you had these type of parents or you were in this type of neighborhood where your parents could just step out on the porch and call for you, they would do that. So if we think of the 200 EMA, 20 EMA, and again, you can substitute SMA for EMA when I say it. So don't get too distracted by that. Just EMA, SMA. I'm going to say EMA because I'm used to saying that. 200 EMA and the 20. If the parents call the kids back, they will come back home. And that's what happens with the relationship between the 200 and the 20. If the 20 EMA gets really extended, y'all see that space in between the 20 and the 200? Y'all see this space between the 20 and the 200? Y'all see that big gap? Whenever the kids get too far away from home, they eventually get called back. And this happens all the time in the market. This is gold if you really catch this concept and you learn how to enter and exit trades based on this information. It can relieve a lot of stress trading the market. Let's get back into it. We have the 20 and the 200 in a really close state right here. Y'all following me? If you notice, the price is reacting right around both. This is what you would call a consolidation area. This is where there was an indecision in the price of this particular stock. So Meta, around this time, the buyers and sellers were duking it out. What we find out is the sellers end up winning in this fight. So the bulls were winning, the buyers are winning. Sellers step in. The buyers aren't ready to give up the fight. The sellers are stepping in. Buyers aren't ready to give it up. And then they just fucking, excuse my language, and then they just give it up. And eventually the price reflects that. But notice what's happening with the 20 and the 200 during all of this. They get into a tight or a narrow state. They're close together. This is when you have to pay attention because you get price changes from this. There's only two states that the 20 and 200 can be in. They're either in a narrow state, tight like this, or they're in a wide state when they're extended and separated like this. It's all they can do. So wide, back to narrow, back to wide, somewhat wide, get a little narrow there, getting more narrow here where we currently are getting, and then it got wide again. So it can only do this. Narrow state, wide state. The 200 EMA is home base. mom and dad. This is the grown folks. The 20, sometimes they get a little out of hand. They get out of line. They want to get away from the parents, but eventually they get called back home. So this is a very interesting dynamic when you learn and you start seeing this on charts. And it's the same. I know some people are maybe asking, can you do this on a shorter time frame? Absolutely you can, and this is what I use to day trade. I take away as much stress and guessing as possible. So I know when the 200 and the 20 get separated, whether it's to the downside or to the upside, whenever they get super extended, they have to come back home. The price will come find the 200, as you see it did here. Got extended, came back home. Got a little extended, came back home. Got a little extended. Kids was going through something bad. They had some downtime, whatever it was. But eventually they're going to get called back home. This is incredible, guys. So think about if you only bought calls when it was super extended to the downside. Calls means you're expecting the price to go up. Think about if you only went short when the price was super extended to the upside, meaning you're expecting the price to go down. As soon as the kids get away too far away from home, you should be expecting them to come back. And this is meta. Super extended to the downside, came back home. Extended to the downside, separation, tight, narrow state, spread out state, wide state, come back home. Just to go back to the other side. So use this, guys. I don't want to beat a dead horse. I think y'all get it because y'all are smart. But use this. Plot the 200, plot the 20. Start looking at where they are in relationship over a longer period of time down to a shorter period of time. If you're day trading or doing like short swings, pay attention to where the price is around the 200 and the 20. See how the price reacts around those when you plot them. And then you can learn to only take trades when it's a certain type of picture or a certain look. If you only want to do calls, you're only comfortable doing calls, well then you should only be getting in calls when it's a narrow state moving to the upside, 20s crossing the 200, or when it's super extended and separated from the 200 in these deep value zones, right? So since we can't ever time the market and know exactly when the bottom or the top is, this is just something to help you. It's just something to help guide you. Okay? It's not meant to be absolute because nothing is absolute in the market, but this is a wonderful guide to help you understand if price is too extended, what the trend is, who's in control, and with that information, you can make more educated decisions on your trades. Use this to your advantage. All right? That wraps up part 2, y'all. 200 EMA, 20 EMA. Check it out. Rock out with it. Let me know what you guys think. And, of course, like and subscribe if you like this material. If you like what I have to say, if you've got questions, hit me up. I'm an open book. I love this. I can talk about it all day. Let's get it. Let's get to this bread. We're closing out the end of the year, so I do want to say shout out to everybody ending 2024 strong. Let's open up the year 2025 running. We're not waiting. We're going through the finish line into the new year with momentum. Let's get it, y'all. This your boy, Train the Trader. I'll holler at y'all next time. Peace.